Hello, everyone. This is Andrew Berman from Mortgage News Network, National Mortgage Professional Magazine. Thank you for joining us for another Mortgage Leadership Outlook. So excited today to have you joining us. Today, actually, no surprise, like every other day, we have an amazing guest. So today, Jerry Schiano is going to be joining us, who's the CEO of Spring EQ. This is a man who's just been a career mortgage banker, a mortgage entrepreneur that's been very, very successful multiple times over. We're going to bring him on. So, but please, actually, listen, if you are joining us, please share this. We want to get actually the message out there. We want to know people are watching this. So please do us a favor, share this message, get this out there. And without further ado, I will bring our guest in.
Hey, Andrew. Good. How are you?
Good. So, listen, thank you for joining us. Always great to spend time with you. And again, listen, if anyone is joining right now, please do me a favor. I would love to see where people are connecting from. Let us know the city and state you're connecting from. So do me a favor, use the comment box, whether you're connecting from Facebook, whether you're on here on Twitter or coming into us from YouTube. Please let us know in the comments below where you're connecting from. Thank you so much. All right, so Jerry, listen. I'm going to get right into this with you. So let's take a look back. Let's start actually at the beginning of the year. If you could do us a favor and talk to us a little bit about the timeline of what happened in terms of the capital markets, where we went from from things were looking great to the conditions that we're in right now.
Well, what a difference a few weeks make, or a few months, right? In the beginning of the year, I think everybody was busy, very excited, and thought they were going to have a record year. Capital markets, people wanted to buy more loans, creating new non-QM products, creating new second mortgage products, which we've specialized in. And the investor appetite was strong. And then all of a sudden, overnight, as everybody knows, the investor appetite just vanished. Basically, what happened is if you were counting on Wall Street left. And those of us that were counting on Wall Street had to figure out a different plan. Otherwise, it was going to be tough going.
So what was the plan? So here, actually, all of a sudden, Wall Street, because listen, Wall Street has loved you for many, many years. You've actually done a great job of finding actually times, where there's an opportunity to serve homeowners and find actually, where the appetite is for investors, and kind of, make actually these meetings of the mind. I mean, it's happened. Listen, I love you. One of my favorite things is actually New Penn. New Penn is actually like this great story about actually how, as New Penn was started in 2008.
2008, after the demise of the financial markets, correct.
So 2008, and this is but by the way, this is after you sold your company in 2006, right. Which is like amazing timing. So I mean, probably also a great timing to start actually. So what happened actually in 2008 that led you to say, hey, this is a good time to open up a mortgage company where everything is falling apart. In 2008 actually. We still actually had a lot of servicers dealing actually, with the deluge of foreclosures and defaults that are happening. And you're saying, hey, 2008, we're going to open up a mortgage company.
I don't have skills to do much else. No. What happens is I have a belief that there's a mortgage business. Yeah. I've been around the mortgage business for many years, and this is kind of the third big crunch that I've seen. But at the end of the day, when you get past the panic, people are going to buy houses. People are going to need to finance the houses. Very few people have $300,000, $400,000, $500,000 to plop down cash. Quite a few do, but most people don't. So I believe in the mortgage market, right? So that's the reason why I knew it was disrupted. And sooner or later, the waves stop and it gets a little bit calmer. So when we came in 2008, we thought we understood what was happening. We had a chance to look at it from the sidelines and adapt to a new market and the quality of that market. And we thought it was a good time to enter. And if we figured if we did the right things and we had the right quality, eventually we would be able to lend more and more and satisfy a lot of customers. People are going to buy homes. It's still a great job to refinance. One of the ways I think people are going to get out of this is, I believe it might have been the NBA, but don't quote me on this. predicting interest rates at 2.9 or 3%. So one of the ways that I think this economy is going to go after it settles down is we're going to see a lot of refinances as people put more money in their pocket. So I believe in mortgage finance. That's why.
Yeah, that makes sense. So I mean, and the focus when you opened up New Penn was portfolio product, right? I mean, you guys wasn't even non-QM, and later became non-QM, but you guys created your proprietary products, which was unheard of in 2008.
Well, what we did was we actually in the beginning we focused on Fannie and Freddie because that's all that was there. So what we did was we took what was there. I try to simplify things and say there's two mortgage products. There's government-backed mortgage products, and then there's other products, right? Yeah. So now those other products could be non-QM, they could be home equities, or they could be whatever it is. So, but when the mortgage market contracts, then people rely on the government. So it's Fannie, Freddie, Ginnie, and that's really what's happened now. And even more so, they're tightening up even the Fannie, Freddie, and Ginnies, right? When the market expands, and this is what we did second at New Penn, when the market expands, then you can go to Wall Street, because Wall Street, then you could go to Wall Street and have them create products, or you could even go to depositories and work with depositories and create products that don't fit within the agency and the government structure. So in 2008, that's what we did. We started Fannie Freddie, and then we evolved from there. And that's, if you really, come all the way to today, that's really what's happened here is all of a sudden there was the non-QM market was finally getting robust. There was other products being developed. And then all of a sudden that product shut down overnight. So what are people doing is I'll say they're rushing to quality, right? That's not to say that non-QM and other products aren't quality, but they're rushing to quality where it's backed by Fannie and Freddie and Ginnie. And that's what we see the market doing. And not only just those products, but the highest quality Fannie, Freddie, and Ginnie, and it'll be that way until, everything calms down a little bit. People start getting back to work and the economy starts opening up. But right now, everybody's retrenched, and it's logical and it's smart.
So the rush to quality is so. That wasn't something that happened 2008, but that did happen 98. 98 was that flight to quality, rush to quality. That I remember hearing that term actually in 98. Yeah, right, 98.
And it did happen before. It did happen as 2008 was melting down. All the other products went away and it went to the agencies.
Yeah. So, well, and when was your first securitization from New Penn?
Oh boy, it was at a wrong time. I forget the year, but it took us. It was right after. It was not long after we sold part of the company to ShellPoint, and we did one of the first securitizations as that securitization market opened up. And some of my partners at ShellPoint, they're really the securitization experts, and they did a really good job of working to open up that securitization market. My job has really always been the origination and operations side of that. I've always relied on the Wall Street side to help on that side.
Fantastic. So listen, I mean, give us what led to the idea of creating Spring EQ, a company that's dedicated to kind of unlocking the equity that's been building up in borrowers' homes?
Well, in hindsight, a complete crazy idea. I had this idea that interest rates would go up. Now, boy, that happened for a little while, but clearly we're not in that time now. Now, what we found along the way, though, is something interesting. Is as interest rates went down, at first we feared that our home equity business would dry up, and it quite honestly it did the opposite. Because what we found, and we've added, we now have a home equity and a first mortgage division at Spring. And what we found out is pretty simple, is some customers should take out a home equity and some customers should do a cash out to get the cash that they need. And what we do is we like to have both products because we think we could satisfy the customer's need rather than pushing the customer into the only product we have. So my original premise was wrong, but we were, I guess, lucky that we found that people let's face it, people need cash. And the other reason why we set up Spring is a lot of people were getting cash from these new fintech lenders. And some of those deals are really good, and some of those deals are pretty high interest rates. Yeah. And all of those deals are lower amortization terms, right? So we thought we could provide a better price and a better product for our customers along the way. And I have one of the problems with the virus is I have an annoying cat that likes to get involved in all Zoom calls and things like that.
So. What's your cat's name?
That is Sky. So
Sky. Fully black? Is that a fully black cat?
That's a fully black cat.
So basically, all the hundreds of viewers just got bad luck because a cat crossed that path, right?
Yeah, she's a good cat, though. Pain in the neck, but a good luck cat.
Oh, that's great. That's listen. This new norm is created. I mean, think about actually how many times would it have been appropriate that your pets, your children, 3 months ago joined your Zoom call, and now it's expected. And now not only expected, but people want you to bring them in and embrace them in the call.
Well, let's face it. I think we've all become a little bit more real in this as we're talking to people from home, and you see people not necessarily dressed for work. And I've seen a lot of my coworkers a little bit less shaven than they normally. And
it's great. Listen, but let me ask you this: how's their productivity? So from a being able to work, is it most people at Spring EQ have been belly to belly, right? But
yeah, we pack them in a little bit tight.
Okay, so it's mostly been Spring EQ, people belly to belly. So and that's been always actually something that's been important for you. Whether it's in Wilmington, obviously for Continental Grain or Conti. I don't think actually that even anyone talked about working from home back then. So that's always been an important thing for you, right?
Yeah, I like the vibe of we have almost like a trading floor office where we put in a lot of people in there, and I like the hum of that. So we were lucky that this happened now rather than 10 years ago, because our technology allowed us to bring 140 people to home without a glitch. We had actually lucky enough that a bunch of our people were already on laptops. When we thought this was happening, we got everybody else laptops. And basically with our system is you take your laptop, you take your phone, and quite honestly, we didn't lose any productivity. Matter of fact, you could make an argument we gained a little bit. Wow. But a lot of people are saying that. But what I would say is I think that's a false measure, because right now there's almost no weekend. Everything is the same because nobody has any place to go. Right. So I hope I'm wrong, but I think we're going to see a reduction in productivity as they open things up, and especially initially because people have been cooped up. So they work. It keeps them busy. Right. But I think when the world opens up a little bit, I think we're going to see a little bit of productivity come down. Now, we have a group of people that always work from home. And one of the things we have told our people, because a lot of people want to work from home, and quite honestly, I've probably been a dinosaur. I like that less, but maybe I'm learning new tricks. And what we told our people is, convince us you should work from home. So do a great job, and give us the incentive to do that. And so we're looking at that. And if we can get more people to work from home, that's great. We were just about ready to sign a lease to double our space in Philadelphia. And if we can have some people work from home, it's always good to not have so many leases. So we'll see.
Yeah, and you're downtown Philadelphia, right? You're like in the center, so it's AAA space, I'm assuming. So it's not inexpensive, right?
No, it's not. Our philosophy is always we like our people to go in a nice building.
Yeah,
I think people want to come to work in a nice building, but we just give them a little bit of space in that nice building.
Yeah. So now, in the nice building, traditionally, what's the dress like? I mean, is it golf shirts? What's the dress code like if you're gonna work for Spring EQ?
I would say it's casual. Yeah, we allow jeans, we allow khakis, we allow we don't want anybody to wear anything offensive. We don't want to, but generally speaking, we have a lot of millennials, And, you know, the millennials, they dress a little different than when I was first starting in the workforce. And it's fun. You know, it's as long as people, you know, are respectful and wear something that's, you know, not offensive, and they're comfortable. You know, what we found, that's better. We do all of our business through call center, so we're really not seeing customers. But it's a much more casual world today anyway.
Yeah. So let's go back to actually so I know actually, you know, obviously Spring, I know New Penn, Wilmington, Conti, Continental Grain, like, you know, but how did you get into this business? Like what sucked you into the mortgage business?
I hated the job I had before this.
What was that?
I worked in marketing for an insurance company that when I first started working there, it was a really good place to be. And I was a junior employee, and 3 of the senior people left basically overnight to start up a different company. And the company got more and more bureaucratic. And I happened to be lucky enough to work with a woman who we were pretty friendly at work, but really not so friendly after work. And one day she mentioned her husband had a mortgage company and he was looking to hire. And I really just wanted to leave my job. So he basically offered me an offer I couldn't refuse, half salary and commission. And I said,
yeah, it's a great deal.
He gave me 6 months of to basically cover me, and said, you know, in 6 months you'll either really get it down or we'll probably fire you. So if I liked my job, I would have never taken that. So I think I look back and say that job that I didn't like was the best thing that happened to me.
Wow. So
I wouldn't have taken the risk of, you know, I was never a salesperson before that. So I went into managing sales and first time commission. And it was not soon after I had my first child and house. And so it was just, I was lucky.
Was it before that 6 month period where you had your first child?
No, we just had it. So before that, so it was a lot of pressure. So it was good. It ended up working out.
Wow. So and big insurance company, like it was like, you know, they did everything.
Yeah, it was a big insurance company, part of a public company. I had a nice office, a fancy title, and I went into the mortgage business. And my first day in the mortgage business, they forgot that I started that day. And my first day on the job was they didn't have any space for me, which is typical of mortgage companies. So my first job in the mortgage business was I had to clean out a supply closet. It's true. And they put a little desk in there. And about 2 days later, like this, one of the clients walked by my office and he goes, "Wasn't that a supply closet?"
Okay, so you've got this fancy title at a big insurance company. You're in the marketing department, and someone says, "Hey, here's a good opportunity. You're gonna make half the money that you're making. I know you just had a kid. Go in this closet." That's basically so.
I didn't say go in the closet. That might have made me change.
So what did you do to first generate that business? So here you are, actually, you know, you're like, okay, what do I do to get out of this closet? How did you generate your first business?
Well, it was a different time. It was, you know, the mortgage business then was, you know, it had a lot more margin in it in the business that I was in, and it was not as sophisticated as the business is today in so many ways. And there was a lot of opportunity. And, you know, what I did at that time was I basically, you know, I would go visit potential clients and I would be honest with them. I said, look, you know, I'm a month, 2 months, a day in the mortgage business. I'm not going to pretend to know, but I promise you, if you tell me what you want, I'll do my best to see if I can get it for you. You know, so, and that's what I did. And, you know, basically everything is kind of rote. You know, you run across the same things that maybe, and every time if you really ask the question, you learn what it is. So that was kind of the way I learned. And since I couldn't offer expertise, I offered effort. And that was good enough. And I was lucky to have some of my, you know, clients at that time, you know, give me a chance today. And some of them are still very good friends today after that much time. So.
Wow. You know, and by the way, that to me says so much actually about just being honest, being open, and not fake it till you make it. That fake it till you make it thing is just something that when I hear people say that, it always makes me uncomfortable. And when you're just honest and you just share, actually say, listen, I don't know actually that, that I'll have all the answers, but I can guarantee you that I'm going to work my butt off to find out the answers. It puts the person in the other position of saying, how do I help this guy? This guy's a genuine, unique person that I feel actually has my best interest at heart. Because listen, even the person that's been in the business, for 20 years that closes 100 deals, they don't know everything. So that's not to say that person's going to be able to handle the business better than someone that just got in the business a few months ago and is working out of a janitorial closet. But the fact actually that janitorial closet worker is being upfront and laying all those cards on the table, much better off going with that guy than just the person who might not. You never know. You never know. Actually, and that fake it till you make it thing is something I always worry about.
I don't like that. And I worked with this guy years ago, and he told me something that that was, a key. He said, always ask why. Because if you work for a company, and especially a big company, there's so many policies. So people ask how to do this and they just get the policy and they leave it. What this guy told me is if you really ask why, first of all, you'll find out that, a lot of people don't know why. They're just following the policy. And second, when you really ask why, you begin to understand it. And then if you begin to understand it, you could either challenge when it doesn't make sense, or maybe you could, have a chance to improve it. So that's kind of what I thought. And that's what we look for. We hire a lot of fresh outs or younger people in processing and sometimes in loan officer in training. And all we want them to do is give effort and ask why and learn, and that's the beginning thing, because if you have effort, wins, in so many things. I'm not a big person at all these sales trainings, but, you hear these things that, 92% of the people or whatever number they make up don't ask for the sale or stop after this point in time. And I'm a big believer in effort.
Yeah. Well, listen, there's no question about it. It's effort. It's activity. So I think actually, just doing doing what you need to do on a daily basis. I thought this was great. Lori said that she still works in a supply closet. Can you get her out of that, please? We also have Lisa. As I worked in a supply closet too, as I started in real estate, decorated to the nines.
That was better than mine.
yeah. Listen, Lisa, you should be sharing some pictures. Would love to see what that decorated supply closet. Sure. Right now, it's and here we go. Okay. Oh, Lori's tagging people. Thank you, Lori. Appreciate that. That's great. That's great. So let me ask you, do you miss that activity of going out there, finding the business? I mean, is that something that, when you started managing people and started getting actually to the executive level, that you just were glad to get out of it? Or what's your feelings about your days of pounding the pavements for loans?
I would tell you that anybody running a company never gets out of that. It may be different things you do, but I can tell you, you can go to all the CEOs that they're all trying to get business in their own way. And that's kind of what we do. We try to get partners. There's some companies that don't have the ability to do home equity. I call on them on a regular basis, trying to partner with them. We have a first mortgage business that we're building. We're working with some people in an affiliated basis on that. So in a different way, I'm always selling. My job is to make sure this company, is stable, vibrant, and growing. And with that, I might be selling a new employee to come to work for us. I might be selling whatever that is, but my job is always selling. And I think most CEOs would say that too.
Yeah, listen, I agree with 100%. It's CEOs, it's everyone. I mean, whether you're, listen, even if you're an underwriter, you're selling actually why you can't do this loan or why you can do this loan.
True.
it's everything we do actually. Even if we're listen, if you're even a janitor, you're selling actually yourself, doing actually the best job you possibly can. So hopefully you can get a raise. So yeah, I think that's a great point, Rose. So I want to just talk to you about are you setting up new relationships now? Is this actually a time where you're going to actually entities and saying, hey, listen, we can help you actually when it comes to the home equity piece?
Yeah, I mean, I don't know how many phases, but let's say kind of a crisis, there's a few phases, right? So that when this first thing happened, the first thing for us was, survival. It was like, how does this affect us? What do we have to do to make sure that we're a stable company? And that was kind of the first thing. And what do we do with that? That's basically making sure our employees are safe, making sure we have people working from home properly, make sure our systems are working, making sure we could satisfy our customers, making sure our vendors are still working and we can get people to appraise and close our loans and do e-sign and things like that. So that was the first stage. Then the second stage was in some of our product, we had to rebuild because we were dealing with Wall Street, right? So there's three places to get product, right? Wall Street, I say Main Street, which are banks, and the agencies. So what we did was we switched some of our sales focus to agency for traditional first mortgage and generating that business, which we were already doing anyway. And then the second business was I've been spending a lot of time dealing with depositories, banks, and credit unions who want to buy our products. So when non-QM product went away and a lot of other product went away and some banks have shut down their home equity lending temporarily, we had to cut back on some of our product. But right now we're still lending, a 20-year home equity product at, 5% fixed rate, so it's still a pretty darn good product. But that's about rebuilding our capital markets on the fly. Sorry, we have a pest here. That's rebuilding our capital markets on the fly. Now what we're doing is we're adding to some of the relationships we have that we can do first and seconds with. And we're starting to, staff up a bit. I told you in kind of our pre-call on the 13th, I was actually in Florida getting ready to open up a center in Florida. And all of a sudden everything shut down. We kind of delayed that, and now we're starting. We're not ready just yet, but coming. When we start to see some things open, I think we'll go back in there and revive that opportunity. So because I really think that we're going to see, or I hope we're going to see, a pretty good run of first mortgage refinancing as rates settle down. I mean, rates are a little bit higher now, and it's logical because of the uncertainty. But really, when you get past some of that uncertainty, where the rates are, it should go down much lower. And, we're trying to be prudent and get ready to do that.
Listen, I think she wants to be on. Is he or she?
That is a she.
Okay. Oh, is that not the black cat? There was a different one?
No, there's two cats. That's just the annoying black cat.
So we got a question.
It's insisted on getting these cats, which are driving me bonkers. But that's a different story.
You're not a cat. Are you more of a dog person than a cat person, or you don't like pets?
I'm more of a work in the office person. If I work in the office, it solves everything else.
Yeah, that's great.
I've seen some of these little things that come around, where animals are like, what are these people doing in my house, right?
That's right.
We're not normally around that much, right?
Yep, 100%. Yeah, my dogs are not used to actually all this attention, all this activity, all the walking. I've never walked my dogs as much as I walk them. I walk them 2-3 times a day, and I would admit, because most of the time we just let them in the backyard, and they would just go out. And now I'm walking 2-3 times a day, taking them for walks. So, got a question from Joel Berg.
I'm walking 7 miles a day just to keep myself from going crazy. And I think all last year I may have walked 6 miles total year. No.
Yeah, and most of that was in airports.
Probably.
Yeah. Yeah. So we got a question from Joel Berman, aka my dad. With potential declining values, how will home equity market adjust to thrive through the change markets?
Well, if you really look at it, it's a great question. There's been record home equity, right? So home equity is record. So what people are saying is maybe there's a 5% to 6% decline in home equity. If you get a 5% to 6% decline in home equity, there still is a lot of home equity in the market to lend, and it's still a really good way, whether that be a second or whether that be a first, for people to lend on home equity. Now there's a certain couple of markets I think that will be more challenged than other markets, but real estate is very healthy. This crash had nothing to do with real estate. Lending was strong, delinquency was good, the practices were strong. You know what I mean? In 2008, the industry had some issues that they had to clean up, and quite honestly, I think we did a hell of a job. And this is nothing about home equity. So I think you'll see, with some job losses in some areas, and some areas, you wonder about some markets like a Las Vegas that are so dependent upon hospitality, how quickly hospitality and conventions come back. But I think overall we have a good real estate market, and overall there's a lot of equity, whether that be through a home equity or a refinance or a cash out.
So listen, I'm going to switch topics here for a little bit. So non-QM, you guys were one of the first securitizer of a non-QM product. Total leaders actually in the non-QM space with New Penn. I mean, it was just great. I love talking about actually the whole story about New Penn. But so do you think actually, because what was being done then, by New Penn, very responsible, skin in the game, extremely, documented ability to repay. Do you think actually, did you see actually anything with non-QM going a little too far, getting away from those original standards?
Well, the last year or so, when I left New Penn, so I haven't been in day-to-day involved in the non-QM. So I think there's people probably who were in that can speak to that a little bit more. But I'll say, as an insider who became an outsider to that, I still think the numbers were good. The delinquency was good. Did a few people get maybe overheated with programs? Probably. But I think overall, I think it was a sound market. You know what I mean? And I can tell you, my old company, I think they did a heck of a job, and not only them, but a lot of other people did that. So I think that I think the problem with non-QM is Wall Street stopped, the banks pulled the credit lines, and there's no bid on the product. Now, eventually that'll calm down and that'll come back. And the question then is, are people going to provide warehouse financing or long-term financing so people could gather the product in enough time to securitize it? That I think may take a little bit of time. And then if you go to the non-QM product on a correspondent basis, are the warehouse lenders who may have been gotten burned this time going to be so quick to put that product on their line? Some may, but some may wait a while, because a lot of people got caught with it. So I think it'll take, there's a lot of good reasons for the non-QM product. There's a lot of people who have been shut out of the traditional agency Ginnie market, and it makes sense. It'll just take a little bit of time to get there, I think. But I think there's product there that should be originated, and it'll help customers. You have business for self people who have great loans that struggle. And a friend of mine just mentioned to me the other day, they have a 15% debt ratio. They had a switch of jobs for a couple of months, and their loan is struggling to get done right now because it doesn't fit the tightening standards that everybody have temporarily done. Now that'll go away because everybody's lending in fear right now.
Yeah, lending in fear. That is a great way to put it. I really great perspective. Listen, Your career is great. I love actually being able to follow you. I love actually, the work we started doing at Spring EQ. I'm excited actually that we can get back again and promoting actually the products that you guys have out there. I think there's a huge opportunity. Actually, Joel just mentioned this. I thought this was great. Do you think actually home equity loans could be a better option than some borrowers versus forbearance? And I think this is actually one of the things why originators should be talking to borrowers, reaching out, making sure that they don't do actually, the forbearance if they don't have to. Obviously, listen, if you lost your job, you have no money, you're not getting a home equity loan. But aside from that, if you can pay it, you need to actually pay it and just be worried about the forbearance. How is actually, Spring EQ going to actually address forbearance in the future? Is it going to be something where you guys are going to look and say, hey, there are these missed payments, so we need to be mindful of that in the future? How are you guys going to address that?
Well, like everything, the forbearance concept is a good concept for people who were struggling, right? The problem, I think, when forbearance came out, I think people thought it was free payments. You know what I mean? It's and I see that a lot of the big servicers have started to do a really good job of educating borrowers. You could see that on some of their announcements and some of their websites. I've seen it from New Res, I've seen it from Mr. Cooper, I've seen it from others, where a forbearance really should be not somebody who is not paying for convenience because the government has created a program. It should be for the people who have a hardship. Now, the government hasn't required a proof of a hardship. Now, that's only for agency loans and stuff like that. So the way we approach it is, let's understand what's happening with the customer. And let's make them understand what forbearance really is. It's not that the payments go away. You still have to pay them. And then for the people who really need it, let's get in there and dive in there and help them. And for the other people who may think it conveniently is something to do, I think you got to educate them that may not be the best thing for them. And if we could really focus forbearance on the people who need it, I think that's better for the people. It's clearly better for the industry. And I think it's better for housing and things of that nature. And I've seen, so many people do such a good job of explaining that. And you see on LinkedIn, industry leaders like Dave Stevens and so many other people do such a good job of, what some of this stuff means. And we're trying to just take from that, some of these bigger servicers and educate our customers and be there for when they're needed, but, make sure it's not a frivolous claim. And that's what we're trying to do on the non-agency stuff.
Yeah. And now on the home equity stuff, there's no assistance for you. So in the agency stuff, there's something. If it was, if it's FHA, VA, there's something. So for forbearance on the home equity product, you guys, you have to write a check, right?
Somebody's got to pay the interest, right? So, and it's the same thing. I think people have stepped in on the agency side, but it's still, there's no relief for cash outs. And even the release on rate and terms is 7 points. That's a pretty hefty LLPA. And, so that's a pretty, that's not so much different than the scratch and dent market, so, a little different, but, so I think there's work to be done on that side too. But yeah, but there's people hurting, I think everybody has to know people are hurting right now. You walk down whatever town you're in. It's, as I told you the other day, I took a walk down the town just to see a different site, and you just wonder how many of these businesses are going to be able to reopen. It's a time that's hard to explain. It's crazy.
See businesses boarded up like that. That just blew my mind. I drove past a couple of businesses. I saw a 7-Eleven that was boarded up. So, and that just blew my mind. I figured actually, 7-Elevens, they're, while I know some of them have shut down at 8 o'clock around here, but to see actually a 7-Eleven, to shut down says a lot. So, listen, Jerry, I really, really appreciate. Oh, before we go, I forgot to ask your PPP application. I know you went on LinkedIn. You were talking about actually, you're really discontent with the fact actually that you are a small business. While might be big to us in the mortgage business, but relatively speaking, you're a small business who just started out. You're building up a great product, a great service with great people, and you actually like the PPE seemed like it was meant for a company like you. Tell us actually what happened with the application and your feelings on the whole program.
Yeah, I did post something on LinkedIn, and I'm normally not a political poster, and I'm a true independent. I'm not a big believer, I think, in either of the parties. And I was just frustrated because you went through this process, and when the money ran out, and that's understandable, nobody knew how much it was, but I just thought both sides could have got together a little bit faster and got this thing going. Now they finally did, which was good. So we got shut out of the first round, but we actually got our PPP approval and will be funded within the next couple days. But it's once again, I would not want to be, one of the politicians, because they've had to make so many decisions so fast. And, I think the PPP is a good program. We actually, we did do a slight furlough, but we kept on more people because of the PPP. And I think it did exactly what the government wanted in that intent. So it's come through, and the banks I know were overrun and it was difficult for them. But, when you look at some of the other stories, and you look at and say, maybe because I'm a Philadelphia 76er fan, on that, but that the Lakers originally got a PPP, I don't know. I think that maybe the Lakers, if they really need to raise money, they could sell something to raise money, and they don't need to do that. And now they returned it, but I think there's a lot of other companies that when they developed that program, it could have been tighter. And I think some of these companies are now giving back the money that had access to public funds and things like that. So
yeah, I think the Lakers were started to do N95 masks with the Lakers logos on there. Bam, there you go. There's that. That's how they could raise money.
Yeah, and I'm still mad at the Lakers because being a Philadelphia fan, I would have preferred if we would have drafted Kobe Bryant for them. So maybe I'm just being angry from the past.
The truth is revealed. Wonderful. Jerry, listen, always great spending time with you. Thank you so much for joining us today. We really appreciate it.
All right. Thanks. Stay safe out there.
All right. Thanks. Bye. All right, everyone. Thank you so much for joining us for another Mortgage Leadership Outlook. So excited tomorrow. Patty Arviello is going to be on here. 4 o'clock tomorrow, East Coast time. New York is going to be 4 o'clock East Coast time. California Pacific time is going to be 1 o'clock. So see you guys tomorrow. Please do us a favor, like, share, get this message around there. If you're on YouTube, make sure you subscribe. If you're watching this on the replay, please make sure you can share this with your people. Thank you so much, everyone. Have a great day.